Since the onset of COVID-19 pandemic, many African governments have implemented policy changes to prevent a further spread of the virus. In countries with high level of mobile money penetration, governments have been able to leverage digital payments across to avoid cash and human contacts. But how ready is Africa to implement such changes? Joining me via Skype is Samuel Tayengwa, acting CEO of TransUnion Rwanda, a global information and insight company that provides credit information. Thank you so much, Samuel, for joining us.
Thank you for having me, and good evening to you and your viewers.
Good evening, indeed. Now, the spread of COVID-19, as you heard, has seen a surge in digital payment in Africa and e-commerce transactions as a financial institutions scramble to offer businesses and consumer contactless way of spending and borrowing and lending and all that. What have been the numbers like?
To give credence to that statement, why we talk of a surge or why we talk of acceleration in digital transformation, I think it's important to look at what the pandemic has done, right? The pandemic has created more of a push factor for organizations or financial institutions to improve or to really drive their strategy in as far as digital transactions or digital transformation is concerned. TransUnion Global ran a survey which looked at what has been the impact of the pandemic and as far as transactions are concerned, and we picked that globally about 250% of most transactions are starting to happen online. And if we try to bring it down home, in Rwanda, we have what we call peer-to-peer transactions that usually happens on mobile. We have seen a surge of about 450%, and that has been from pretty much the first cases of COVID were reported to about end of April. If we go to our neighboring country in Kenya, we have picked up that about 34% increases in mobile usage, as well as about 24% in online transactions. And in Southern Africa, we look at South Africa, we saw that about 37% transactions were starting to happen more online. And all of this has been because of a push factor in as far as contactless transactions goes. So the numbers are increasing. We are seeing a lot of that happening across the region.
You've seen governments reinstating charges on cashless transactions. What does that mean in terms of Rwanda's push and Africa's push to be a cashless economy?
I think if we look at how most countries are handling and dealing with the pandemic, it's not necessarily that the curve is flattening. I think if you want to look in Rwanda, in the last week, we saw a report going out of some of the locations around Kigali almost getting more of a lockdown or a curfew again, because we're starting to see the number going up, meaning that COVID or 19 or coronavirus will probably be with us for next couple of months or even into 2021. However, business has to still continue. Organizations still have to make money. And though the government had come in with policies and regulations to try and ease the burden on consumers, in exchange to businesses being incentivized through other means, they had to have a give and take with businesses or with financial institutions in as far as reinstating some of those charges are concerned. We believe that when the charges were reinstated, consumers had been given at least enough time to breathe from what we had seen the pandemic causing in as far as indebtedness or consumer burdening from the pandemic goes. So the reinstatement of the charges do not necessarily say that it's a bad factor on business, but it simply means we need to give businesses and organizations a chance to breathe again from what the regulatory and policies that had been imposed since the outbreak of the pandemic goes.
Samuel, financial institutions face security challenges when serving customers digitally. What are you seeing in the market?
Since the outbreak, we also did a survey, and what we picked was about 100 million transactions that had been observed from about February to roughly about the end of April. More than 100 million of those transactions were potentially fraudulent, right? Meaning that with moving to digital transactions, moving to online transactions, there is a great risk of security threat in as far as consumers' profiles are concerned. Fraud syndicates will take every advantage out there to try and jeopardize the systems, will take every advantage out there to try and steal other people's identities so as to, use their profiles to acquire loans or to acquire to acquire any other form of financial products. So we've seen the numbers going up, and we want to urge businesses, and we've been working with businesses across the region to, hand in glove, to try and look at ways and means of building other authentication layers around their digital strategies, so that when we talk of identity verification, we look at every aspect within the ecosystem that can enable safety for consumers as they transact on their platforms or through their channels.
So what solutions should financial institutions implement to ensure customers can transact digitally without any security concerns?
So when we talk of identity verification tools, right, we look at various options that are there in the market. At TransUnion, we have what we call ID verification, which we offer to our financial institutions, and it enables them to know who they are transacting with or who they're handling on the other side of the equation. But if you want to look at what tools are out there, a lot of tools have been brought to the market. We talk of voice biometrics. We talk of facial recognition tools. All of these tools are adequate enough to assist organizations to start identifying who they're dealing with. Because when you talk of identity, you want to identify the person as well as the device that they are using transacting with your services. We've got device solutions that are out there at TransUnion as well. We have what we call iOvation, which is a global data set of more than 6 billion devices that we monitor on a day-to-day basis, and flagging out any potential devices that could be used fraudulently. So there is enough tools around in the market that institutions should start looking into in as far as offering layers of authentication to protect their customers from potential fraud.
Samuel Tayengwa, thank you so much for joining us.
Thank you for having me.